Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online divorce mediation and valuation services in St. Louis, Missouri. Today, we will discuss business valuations and changes in the IRS for 2022 with a former IRS auditor, Mike Gregory. Mike Gregory is the founder and owner of Mike Gregory Consulting, LLC. He brings 28 years of experience with the IRS in a variety of capacities. During his last 11 years with the IRS, he was an IRS territory manager with responsibilities for up to 23 states, with an emphasis in business valuation and specialist issues nationally. He's also was involved with creating and talking to the IRS about the discounts for lack of marketability and also reasonable compensation. The other book that he has written is called The Collaboration Effect, which basically brings together neuroscience and kind of negotiation techniques in order for you to work with the IRS if you needed to in some capacity. When I was a younger valuator, we would be like, "Oh, okay, as long as the discount for lack of marketability and the discount for lack of control in total isn't more than like 50% of the entity, unless you have extenuating circumstances, like you'll be fine." But has the IRS identified the issues for the audits of business valuations in 2022? Other than, I think you've talked about 3 of them, but maybe we need to talk about them in a little bit more detail, right?
First of all, there is no one IRS.
Okay.
The IRS is made up of individuals. And the IRS in 2020 became functional by different stovepipes. We're now in 2021, almost 2022. They don't talk across the stovepipes. The valuers cut across the stovepipes.
Okay.
But the folks in estate and gift, they're in their own little stovepipe. Okay. Having said that, when I was at the service and I had a business valuation, I got reports. I could look up any case in the country and see what the status was, how many staff days or hours have been spent, how many more are expected to be spent. I get a little blurb of the status of the case. I get a number of different statistics, and I could look at any information document request or any proposed adjustment, all on this big system. Well, that was too much. So we put together reports that I could pull that together to say, here's one that looks odd. I want to just find out what's going on there. Or I would do operation reviews of my managers and find out what's going on here. Well, having said that, they don't even have people to put the reports together anymore. So nobody's looking at them from a big picture. That having been said, I can tell you, I've been in business now 10 years. I worked with the IRS on issues and exam and appeals, and even with counsel across the country. And the culture is very different in Manhattan than it is in St. Louis or out in LA or Dallas or Miami or Seattle. So now we're talking about whenever I'm involved with an audit, I ask, who is the estate and gift tax attorney? Who's the agent? And where is that person located? And where's their boss? And where are they located? So somebody in St. Louis, Missouri may have a boss that's in Los Angeles, just as an example. And then I'll ask the business valuer, where are they located? And where is their manager located? And I'm finding out different. I ran into a case, I'll just say on the West Coast, where one of the valuers said, I don't allow DLOMs over 20%. You don't allow DLOMs over 20%? And I'm actually mediating here between the IRS and the taxpayer. And I said, are you aware of the IRS job aid? Because I championed that. And actually, this person worked on it. And he says, yes, I am. And I said, no, what does the IRS job aid say about DLOMs? Well, there isn't any maximum or minimum on a DLOM. It's all factual based. So I took the appraiser's appraisal and I asked questions of the appraiser. And I want to make sure the estate and gift tax attorney and the estate and gift tax attorney's manager are there because they're the real decision makers. The valuers are consultants. They don't control the case. And as I asked questions, there's a partnership here. And one of the elements was this partnership had been in business for 11 years. They've never made a distribution. Just think about that. Are they ever going to make a distribution? Who wants to buy in on a partnership that's never given a distribution and never plans to give a distribution as far as we can tell, okay? So I ran through something called the Mandelbaum factors. And then I looked at the IRS job aid and they have 33 factors. Mandelbaum has 10, 9 or 10, depending on what you call a factor. And then the IRS job aid is a total of 33. So I pulled up 8 more items out of the job aid. And I pulled up some real key items like this distribution element. And I ran through, well, I'm just talking to the estate and gift tax attorney and that value. And I said, if I understand risk, you have a choice. You can buy a stock like McDonald's and I can get my money back in 3 days. Or I could buy into a C Corp. And if there is a distribution, I get it. And then I can pay the taxes because I received that. If I have this 1120S type entity, then even if there is no distribution, I have to pay taxes, right? And here I am with somebody that hasn't even made any distributions and doesn't plan to. Wouldn't you think that might be higher risk? Now, I'm saying that not to play to the valuer who knows the answer to that, but so the estate and gift tax attorney and the estate and gift tax manager can hear those questions. So after I asked a bunch of questions, this IRS valuer says at one point, I'm just going to wash my hands of this. Estate and gift tax attorney and estate and gift tax manager, you can do whatever you want on this case. Okay, but he started off with it can't be over 20%. Well, as a result of that discussion, the valuers are now all gone for the taxpayer and for the IRS. And now my client, who's an estate and gift tax attorney, is now talking with the IRS agent and the manager and comes through with, these are what I heard as some of the key points, and help the person go through the key points. And then they said, we'd like to close this with you. And I think from what you heard, 20% did not seem reasonable. And we put 35% on the return, and we have how we got to that 35%. And we went over all those elements with this Mandelbaum case and then some additional factors. Well, we really think it should be around 35%. Can we find some way to work this out? And the estate and gift tax vote said, we can't offer you a proposal, but you can offer us a proposal. Well, could you live with 34%? To which the IRS said, we could agree to that. So it was a 1% change on the DLOM. It wasn't a no change. There was a 1% change. So there was a change resulting in some additional amount of estate tax in here. That's an example. And they worked it out, but that's an example of the valuer who was, in my mind, not reasonable. But I never wanted to say you weren't reasonable. I just wanted to understand where you're coming from and why. And then I wanted to ask other questions about their appraiser, where were they coming from and why. And then we asked, did you consider some of these other things at that time? They wrote the report. They said, I hadn't considered those things. So we brought those into the discussion too. And all these are being listened to. You want to present it in a way that's not ever attacking. It's emotionally, I'm trying to help, seeing if we can reach an agreement on this. And the decision maker has to understand what you're doing. It's not the business valuer. It's not the business valuer's manager. It's the estate and gift tax attorney and the estate and gift tax attorney's manager.
With the IRS.
With
right?
with the IRS.
Right.